Over the past few months, ULTY went from being the poster child of high-yield ETFs to one of the most disappointing performers in the covered call space. The fund exploded from around $250 million to over $3 billion in assets, but lately, it's been all downhill. Dividends, still flowing. NAV, down, and that's where the concern begins. So in this video, I'll break down exactly why ULTY is dropping, why I'm personally trimming my position, and 4 weekly dividend ETFs that could take its place going forward. Hey, I'm Noah, and if you're working toward early retirement or just want your money to start working harder for you, you're in the right place. Go ahead and subscribe, tap the bell, and let's get started. Oh, and just a quick reminder, this video is for educational purposes only and not financial advice. Always do your own research before investing. If you love income, but you also care about protecting your capital, this one's for you. Let's start with the obvious question. What happened to ULTY? When YieldMax launched this fund, it was one of the most exciting ideas on the market. Weekly income potential, diversified portfolio, upside participation, amongst others. Massive yield potential using an aggressive options overlay. For a while, it worked beautifully. But recently, ULTY's NAV has fallen over 20% since summer highs, even though the broader market stayed green. The core issue isn't the yield, it's performance decay. YieldMax shifted its strategy earlier this year, and since then, ULTY's returns haven't kept pace with its distributions. That means investors are collecting great dividends, but their capital base keeps shrinking. When your fund keeps paying high income but can't maintain its value, that's a signal something deeper is off. And that's why I've decided to start exiting my position, not because I dislike the fund, but because there are better performing alternatives that balance risk and reward more effectively. Now, some people say it's just volatility, but this isn't just a market dip. ULTY's NAV erosion suggests the option strategy hasn't adapted well to market conditions. The market recovered, yet ULTY's price kept sliding. When the underlying stocks move sideways or slightly up, cover call strategies can struggle, especially if volatility premiums shrink. So while ULTY's yield still looks attractive on paper, the real total return, NAV plus dividends, has underperformed. That's why I'm shifting my focus to other funds that generate weekly income without draining principal as quickly. Let's start with NVDY, the YieldMax NVIDIA Option Income ETF, and this one's been getting a lot of attention lately. NVDY launched in May 2023, and it's already grown to around $1.7 billion in assets under management, which shows how fast investors are chasing high-yield opportunities. Its goal is simple: generate weekly income from NVIDIA's volatility while still capturing some of that AI-driven upside. Now, how does it work? Instead of just buying NVIDIA shares, NVDY uses a synthetic position combined with covered call and put options. In plain English, it earns option premiums every week, essentially renting out NVIDIA's price movement to generate income. That's why it pays weekly distributions, usually offering a yield in the 7 to 9% range. In some months, the yield has even looked higher on paper. But remember, those huge percentages often include short-term income spikes that aren't guaranteed to repeat. Here's what stands out. Despite market pullbacks, NVDY's NAV recovery has been noticeably stronger than what we've seen from YieldMax's ULTY. The reason? NVIDIA itself. With massive earnings growth, record margins, and nonstop demand from AI, the underlying exposure keeps NVDY's value more stable than funds tied to slower-moving assets. But it's not a free ride. The expense ratio is about 1.27%, and because of its option strategy, the upside is capped. When NVIDIA skyrockets, NVDY only captures part of the gain. So who is NVDY really for? It's for investors who want weekly income tied to one of the market's strongest growth stories and who can handle some volatility in exchange for that steady cash flow. If you're building an income portfolio and still want exposure to innovation, NVDY might be one of the smartest ways to bridge both worlds. Next on the list is a brand new entry shaking up the high-income ETF space, KYLD, the Curve High Income ETF. This fund officially launched on October 30th, 2025, and it's built with one mission to generate steady weekly income from a portfolio of high-growth U.S. stocks, using a sophisticated options overlay strategy. Let's go through the numbers first. KYLD comes with a gross expense ratio of 1.16% and a net expense ratio around 1% after fee waivers slightly lower than most income ETFs using active options management. Its NAV currently sits at $25.19, with a market price of $25.24, showing that it's trading right in line with its intrinsic value. The fund has also seen strong early trading volume, over 118,000 shares in a single day, which is solid liquidity for a newly launched ETF. Now, what makes KYLD interesting is how it's positioning itself differently from high-risk names like ULTY. Instead of chasing extreme volatility, Curve is focusing on a balanced mix of high growth and defensive positions. The portfolio gives investors exposure to innovative tech names like Broadcom, AMD, Intel, and Shopify, while also mixing in commodity and materials exposure through gold and silver miner ETFs like VanEck Gold Miners and Global X Silver Miners. This structure allows KYLD to generate weekly income by selling covered calls on these holdings while maintaining room for moderate capital appreciation. It's designed to convert short-term volatility into a recurring cash flow stream, ideal for investors looking for regular income without taking extreme downside risk. Another edge is its tax-efficient setup. The fund notes that option premiums may not be immediately taxed, giving investors a potential break on short-term liabilities. Bottom line, KYLD is still brand new, so we'll have to see how it performs once distributions start rolling in. But its weekly payout schedule, diversified growth exposure, and reasonable expense ratio make it one of the most promising income ETFs to watch heading into 2026. If you're tired of NAV erosion but still want weekly cash flow, KYLD might be one of the smarter, more balanced replacements for funds like ULTY. Now let's move on to one of the boldest new income ETFs in the market, REX Invest, the REX Shares NVDY Weekly Income ETF. This fund is built around one of the biggest growth stories of our time, NVIDIA, and combines that explosive momentum with a steady flow of weekly income. It's part of RexShares Growth and Income ETF lineup, which targets the most volatile stocks in the market using a mix of leverage and covered call strategies. So, here's what makes NVI stand out. It officially launched in May 2025 and aims to deliver both income and upside performance. The fund structure is pretty unique. It uses a synthetic leverage position on NVIDIA, giving investors exposure to roughly 105 to 150% of NVIDIA's daily move, while also writing covered calls on part of that exposure to generate consistent income. In plain English, that means NVI gives you the chance to profit when NVIDIA rallies, but still sends you weekly cash distributions thanks to those option premiums. Recent payouts have been impressive, with weekly distributions averaging around 0.25 to 0.3 cents per share, translating to a yield between 30% and 40% annualized based on current market levels. Now, let's talk about performance and risk. Because NVI tracks NVIDIA's price movements, it can be highly volatile. When NVIDIA jumps, NVI often amplifies those gains. But when NVIDIA dips, this ETF can move down just as fast. The expense ratio is about 0.99%, which is normal for an actively managed, high-frequency options fund. And while the total return potential is huge, this is still a high-risk ETF weekly pay. Doesn't mean guaranteed profits. Some distributions may even include return of capital, which can reduce NAV over time. So here's the takeaway. If you're an income investor who's comfortable with volatility and wants exposure to one of the most powerful growth engines in the market, NVI offers a modern spin on the high-yield strategy. It's riskier, yes, but also one of the few funds turning AI momentum into real weekly income. All right, let's finish strong with the brand new ULTY, the REX IncomeMax Option Strategy ETF, one of the latest launches in the high-income ETF space. ULTY just hit the market on October 31st, 2025, and is designed for one thing: enhanced weekly income. The strategy targets some of the most volatile U.S. tech and growth stocks, using a dynamic mix of puts and calls to generate consistent cash flow while trying to cushion big drawdowns when markets swing hard. Here's what stands out right away. As of early November, ULTI's net asset value sits at $25.13, down 2.75% since launch. And the fund already has about $6.3 million in assets across 99 holdings. It's still tiny compared to YieldMax's ULTY, but it's growing fast. The expense ratio comes in at 1.25%, which is high, but standard for actively managed option strategies that require constant rebalancing. This fund trades on NASDAQ with a medium bid-ask spread of 0.39%, and it's already showing solid early liquidity. Now, what makes the strategy different from the original YieldMax funds is its IncomeMax approach, a more flexible, actively managed system that dynamically adjusts to volatility. So instead of just writing covered calls on a single stock, ULTI combines put and call positions across multiple volatile tickers, turning market swings into income opportunities. Another key selling point. REX claims the portfolio is structured to soften the blow during sharp market drops, something that could help protect NAV better than older high-income ETFs that simply bleed over time. However, the fine print is important. Distributions currently consist of 100% estimated return of capital, which means part of what you receive could be your own money being paid back. That's not necessarily bad, but it does mean you'll want to watch how the NAV behaves once payouts begin. So, here's the takeaway. ULTI is still brand new, but it's trying to solve the biggest problem in this category: how to pay high weekly income without destroying long-term value. If REX pulls it off, this could easily become one of the most innovative high-yield ETFs heading into 2026. So here's the bottom line. The weekly dividend ETF space is evolving fast. ULTY might still be new, but it represents the next phase of high-income innovation. Investors no longer have to choose between big yields and protecting their capital funds, like KYLD, NVI, and NVDY, are proving it's possible to have both. If you're building a portfolio for real, consistent cash flow, this is where the future is headed. Thanks for watching. I'm Noah, and I'll see you in the next one.